we have Japie Lubbe here from Investec. Those who have attended one of Japie's lectures in the past know he's a very good presenter, very interesting. And so he'll be walking us through the structure today. He will go over basically why he chose things, because he's the one that designed it. He doesn't make any rash decisions about why he puts in certain levels, why he chooses certain indices, why he does certain things at certain times. And he'll give you an idea as to what the structure entails, what your risks involved in, what's your upside, etc. Any questions you guys may have, please feel free to put them in the Q&A section or in the chat section. We will basically answer them either along the way, if it's appropriate at the time, or at the end, and Japie will just go through all of them. We don't have a time limit today, but so any questions you have, we're more than happy to go through them with you. Japie, you can start.
Thank you, Viv. I think maybe just to start with why we do it. So what we have experienced with investors over many years is that to the degree that investors get involved in equities, there's often periods where markets go down. And so the investors get disenchanted with equities as an asset class if they have a bad experience from a timing perspective. And this timing has got nothing to do with the fund manager or the stock selection process. It's just sometimes markets are down. So what we've designed and what we like to promote is exposure to shares, but in a hedged way. Hedged way means that if you invest and your timing is wrong, you still get your capital back. Because then, if that was the case, then you can have another go after that and try again, but not having lost your capital. Secondly, what we find is that people invest for a very long time, and then all of a sudden, in year 20 or year 30, the entire market falls massively. And they've saved for 20 or 30 years, but now in 1 year, they wipe out half the money that took them 20 years to build, okay, which is not ideal. So then it puts them in a very bad position. So that as background, what we've developed is a company structure. So what we're going to talk about today is a company. The investors buy shares in the company. This specific company has already existed from 2008, and the shares in the company are designed to have a 5-year life. During the 5 years, the clients got daily price, daily liquidity. We make liquidity in the shares. But if they hold it for the full 5 years, they've got two certainties. Firstly, they get their $100 back if the markets have gone down. We will talk about the markets in a moment. Secondly, for every 1% the market goes up, the current indicative pricing has shown that they'll get 1.6% until the index hits 40. So if you get 1.6% for every 1 until the market hits 40, you can make 64. But you're making it for every 1, you're getting 1.6. If the market does more than 64, you're limited to 64. And 64 is about 10.4 per annum IRR. So let me go into the presentation, and we'll just share that. Can you see that, Viv?
Yes, I do.
Okay.
Can I see that? Anyone with issues?
Everybody happy? Okay, so let me take you through the summary of the product then. It's a fixed 5-year term. That's the longest that you can hold the shares. You've got 100% capital protection in dollars. I'll talk through the credit that you're reliant on for that capital protection. The exposure is a portfolio of indices made up of 40% S&P, 30 Euro stocks, 15 in Nikkei, and 15 emerging markets. That portfolio of indices is 98% correlated to the MSCI World or country. So for all intents and purposes, you've got world exposure on the equities. It's also with the same portfolio that's in the existing share. So we're just replicating that going forward. We speak of the return being a minimum participation of 150% with an index cap at 40, but we're saying based on current indicative pricing in the market. And also in this case, we've already bought a substantial amount of the bonds that we need for this deal. We've already purchased as Investec and are going to transfer it into the company, and we've got the rates already agreed. It's currently pricing at 160% participation. Your minimum is $11,000 for new money. Maybe just to touch on the maths, what we do is we get $100 from all the customers. We're going to put 71% of it into a debt instrument issued by Citibank. That debt instrument will grow from 71 through to 100 over a 5-year period at an interest rate of 6.95% in dollars. Then we're going to put aside 7% for 5 years of fees, costs, expenses, tax exemption, because this is a Guernsey company listed in Bermuda, and the company pays 0 tax. But it costs us an annual tax exemption certificate of £1,200. Bearing in mind the existing company's 2 billion rand market cap. So that's quite a good expense to have, £1,200 to exempt it from tax. Then that's 7% we put aside for 5 years of fees, costs, and expenses. So having spent 71 and 7, that's 78. So that leaves us with 22%. And the 22%, what we do is we've got a panel of 6 big banks. They have to be rated S&P A or better, be doing business with Investec, and have gone through our credit process. And we price with them what a call option would cost. A call option is an asset that gives you unlimited upside over 5 years based on 100. And at the moment, that would cost about 22. So we could have said, we'll give you unlimited upside, but we don't think the market's got unlimited capacity over a 5 years. We don't think it'll do 300 or 200. So why have the potential to do 300 if it won't do 300? So that's why we sell the cap at 40. That enables us to get a credit of 8.5. So very simply, 22 less 8.5 is 13.5. We still have the 22 cash, so we can take 22 divided by 13.5. That gives you 160. That gives you 1.6. That's why for every 1% the market goes up, the investor gets 1.6. But if the market crashes 40, then they get the $100 back, because the 71 grew to 100, and the 71 had nothing to do with share markets. It's a bond. It's a fixed income instrument. So if we look at the returns of such a share compared to the market, this graph shows you 5-year rolling returns. The light blue line is the 5-year rolling return of the MSCI World All Country, which we 98% correlated to. And you can see, and this is why it's so difficult to make money in shares. Some very good times and some poor times, and good times, poor times. There's no pattern here, Viv. It's just the random walk. And that's what is very difficult for investors to understand and accept, that you can't give them a projection on what's it going to do, or you don't know when it's going to do, well or bad, or there's nothing that you can draw any deduction from. So what we do in this share is we say, if it's a negative period, like you can see where these arrows are, you just flatline to 0. How do you flatline to 0? The 71 still grew to 100. So you get your 100 back. In medium periods here, like anything up to 40%, the investor gets the black line in a share, which is 60% more because he's got that geared exposure. But then it maxes out once he gets 64. So the investor here is saying, I give up these peaks in exchange for not taking losses. If you'd done that from 1987 to now, our observation is that 21% of the time, the returns over 5 years are negative. You see here, these pieces here, those negatives, they're the ones that hurt you in life. If you're taking the average return of the equities with no structure, you would have had 5.5 per annum from 1987 to now. If you could have had the structure, which was difficult because interest rates in the US weren't as high as they are now, you would have had more than 1% per annum better return, obviously with no risk. So it shows that by eliminating the down periods, is more important than actually getting these massive peaks, because the peaks followed by losses eats up your return. And so that's the logic for the offering. But what our recommendation is, Viv, is that the investors buy some of this for their core portfolio where they're taking index exposure. Because obviously at the index level, stocks that are doing well have a higher weighting in the index, and other stocks that are doing poorly fall out of the index. So this is very good for index exposure. But then on top of that, in addition to this, you guys in your active share portfolios and your stock selection, you can then recommend equities that you have a high conviction of. And those equities that have a higher conviction, obviously they don't come with the protection, but they can give you the very high returns if the market does more than 64. So you have the blend of the two. So you're limiting the risk that you lose all your money, or that you lose a substantial part of your money. And you have the benefit that, as opposed to buying an ETF, for instance, you buy this because this gives you protection, whereas an ETF doesn't. And this gives you 160% of the performance, whereas the ETF just gives you 1-for-1 plus the dividends. But the dividends wouldn't easily make up that extra 60% of the market's performance. So if we go on, just looking at this is in a tabulated form. If you start with the market at 100 and the market falls to 50, you still get your 100 from the debt. So that's, you can see the debt is 100, doesn't matter what the equities did. That's why you get nothing from the option, but you still get your 100. If the market did 30%, you times 30 by 1.6 is 48, and 48 plus your 100 is 148. If the market did 50, you only participated up to 40. So 40 times 1.6 then is 64, plus your 100 is 164. So very easy to understand how it is that the returns are. If you look at it from a payoff profile, ordinarily we start where the cursor is. Ordinarily, if the market goes up, we get 1-for-1, unlimited. Ordinarily, if the market goes down, we lose 1-for-1. Here, if the market goes down, we get our 100 back because of the debt instrument. And if the market goes up from the first percent, for every percent, you get 1.6. So now you only need the market to do 40 for you to cash in 64. Okay. Because the argument is for you or I or a fund manager or anybody to try and beat the equity index by 60%, after fees, after costs, after expenses, is difficult when comparing to the indices. It's easy to do, can be done when you're picking 10 individual stocks, but that's a different risk profile. That's another part of your money. Okay. And that's backed up by a lot of research and a lot of homework as to why those specific 10 stocks. But that would be a great combination, the passive plus the active. If you look at the credit risk, what we've done here, Viv, is we've actually already purchased the bonds with a 5-year and 3-month term, and then we'll put them into the company in 3 months' time from when we purchase them. So with 5 years to go at the same yield, okay, same interest rate. And effectively, we've given the money to Citibank. So we give Citibank a 5-year deposit, and they give us a credit-linked note, a note that references a third each, BNP Paribas, UBS, and Societe Generale's Tier 2 debt. So you got a proportional exposure to those 3 names. If you look at the protection for the customer, the first protection in life is the ordinary share value of those banks, because as you would appreciate, Viv, the bank can't default on its debt and still retain an equity value, because equities lose first in the balance sheet. Okay, so for instance, Citibank is worth $86 billion. That's R1 trillion. That's like 8 times Standard Bank or 17 times Investec. That's the market cap. And they've got to wipe out all that market cap if they default on their debt. Second, if you look at the rating agencies, all the debt that we're talking about, just all investment grade rated. Okay, and as you know, Viv, we as South Africa are not, as a country, not even investment grade rated. So why is it that the capital markets of the world rate this paper so highly? It's because the investors understand that, let's say UBS, for UPS to default on its tier 2 debt, it has to have all its equity, $55 billion, wiped out. It has to wipe out all the preference share value that's in the balance sheet, because that's the second guy to lose. And then, most importantly, it's got to get past the Swiss regulator on a quarterly basis, where he gets all the numbers of the bank, all their capital adequacy ratios, all their liquidity, solvency, all their details. And the Swiss independent bank at the central bank evaluates all those numbers and has to ensure that the bank is solvent and liquid and got the capital it needs within the Basel framework. And that framework has been very, very strictly set up worldwide. So the investors understand that the Swiss government, who's got a very strong incentive to make sure that Union Bank of Switzerland is fine, because if they don't and they allow the bank to default, guess who's bailing them out? The Swiss government. Because the Swiss government, you would appreciate, Viv, are going to be very hard pressed to say to the world as investors, you can come invest in Switzerland. It's a very safe place. But the Union Bank of Switzerland has defaulted on its debt. Okay. So that's why the investors understand that the likelihood of this debt defaulting, is infinitely low in our view. So the credit quality behind this is very high credit quality, all investment grade paper. And let's just say the other thing, Viv, that's important. Let's say the investor buys the shares and in 3 years' time, they get to know that BNP Paribas, they don't like BNP Paribas, it's in the press or whatever. They sell their shares. They've got daily price, daily liquidity on the shares. They don't have to keep it the whole 5 year and run the risk if they don't like BNP Paribas. They can sell out whenever they like. Okay, so if we look at what's the value of having capital protection? Well, we've just taken here the graph of the MSCI World over the long term from 1990 to now. Firstly, nice to observe of how markets have come down. So for this, people looking at this as an investment, it obviously seems like a good opportunity because you've just had a 18 to 20% pullback in world markets. But this red box is just there to highlight what happens to investors. We had a share and it was issued in this period of time where the red box is. It had two indices only, Nikkei and Eurostox. But after 5 years, they were still down 44%. Our investors with the same end date got their £100 back, was a pound investment. And you know what happens, Viv, if the market's down 44, you can now go buy the market price at 56, but with 100 check in your hand. The investor who bought the ETF is looking at a statement telling him he's worth 56. Okay. So if a market has to rise 44 on 56, just to get back to where you started, that's 75%. And we saw earlier in the presentation that roughly 21% of the time, the markets are down over 5 years. This was just a very extreme down period. Have a look at this, Viv. It's also interesting that from 1990 to now, if you just had the market direct exposure, cumulative annual return 5.25. But to be fair, that was a very low inflation period, if you think back. But still, it just bears testimony to the fact that if you have the ups and the downs is the thing that hurts you on a cumulative return. Okay, that's the very important impact. So especially if you're a conservative investor or for the conservative part of your money, what you want is you still want the shares, but you just don't want them with the normal risk. If you look at volatility, this is the implied volatility. You can see here, Viv, what happened with COVID. Okay, but volatilities have sort of been coming down a little bit now that markets are picking up. But why we show this is that for someone who wants to buy the ETF, if you wanted to buy 5 year protection, like you buy car insurance, household insurance, medical aid, those are put options. You would have to pay 15% upfront to protect such a portfolio of world equities for 5 years in dollars. So let's say, Viv, to give you an idea, you personally wanted to buy the ETF so that you could get the dividends and have lower fees. You would need the equity market to do, I'll give you the numbers, 62%. Then you would add current dividend yields about 2.3% on the MSCI World. You would add for 5 years the 85% of the dividend that you're getting, but you can only put 85% in the market, another 12. So 62 plus 12 would put you at 74, but then you're only getting 85% of the 74, which is 64. Here, as an investor, you only need the market to do 40 to get 64. Do you see it? Because 40 times 1.6 is 64. Now, coming to why we put the cap at 40, this is an interesting extract that was done by Credit Suisse in the annual yearbook last year. And they had a look at asset class returns over 120-year average. Okay, over 120 years, equities was the best, with 8.2 per annum with the inclusion of dividends before fees, followed by bonds at 5 and cash at 3.7. If you look at that in real terms, the average inflation in the world for the last 120 years up to last year was 2.1. 2.9, sorry, 2.9. So that reduced the nominal returns to the real returns. But then if you compound that for 120 years, you get to 49,000, 1,100, and 160. Now, if I said to you, Viv, what percentage of world investors do you think put their money into international balanced funds? That must be a good 30, 40% of people's money. Now, if this is the 120-year compounded real return of those, the bonds and the equities, which is normally about bonds and cash, which is normally 40 to 50% of a balanced fund, it doesn't seem that smart, does it? What to us seems better is to have all the exposure to the equities. But in that 20%, 21% of the time that the equities are down, then with the hindsight, once you know that they're down, then you elect to take the cash. Because the 71 still grew to 100, so then you take cash. Because cash is always better than a crash. Jot that down. Cash is always better than a crash, in my experience. Now, the beauty here is the only time you're going to get 100 back is if the stock exchange crashed. Otherwise, the options pay out a profit. You see it? So that's a very, very nice position to be in as an investor. If you look at valuations, as I said, because the markets have come down, we're seeing you can buy the MSCI World All Country now at under 15 PE, and the average from 1995 to now is over 20. So it seems a nice discount, you know, nice timing to go in. But Viv, we're very mindful on a macro picture that, you know, bonds interest rates are much higher now. So institutional money will start buying bonds to match the liabilities and match the annuities that those institutions are obliged to pay. Plus, the central governors of the world are taking the liquidity out of the system now. You know, for many years, they were pumping liquidity under quantitative easing, TARP, COVID, but now it's going the other way because they're trying to reduce the liquidity to curb the inflation. So in such a situation, you know, you have all chance that they actually create a recession. And then that's why we want 100% protection in case that happens. But we think that if you've got access to the average return, oh, sorry, I wanted to highlight one other point which I missed. Just coming to this again, Viv, the 8.2% is the average fee income that shares as an asset class created before fees, but with the inclusion of dividends. So if you look at what the investors got, you know, they normally have about a 1.2% total expense ratio, you know, if you buy a unit trust or share portfolio. So the investors on average got about 7 per annum. And 7 compounded for 5 years is roughly 40. That's why we're saying we prefer to pitch the cap at the 120-year average. But then if that happens, get 1.6 times that return. So you're still getting 64 while the market only did 40. But in the 20% or 21% of the cases that the market is actually down, you avoid the loss. Because over compounding, that should suit you very well as an investor. Okay, looking at the individual markets, we're just seeing the S&P is the one that's closest to its long-term average PE. It's slightly cheaper, but it's not that cheap. But if you look at things like the Euro stocks and emerging markets, you know, on a PE basis, they're looking very cheap. If you look at the Nikkei, it's being thrown out a bit by the yen. You know, the yen, the currency, has gone totally haywire. So I wouldn't be too fussed with this graph. It's more important to say that the Nikkei is available, say, at 27,000. And, you know, the heydays before it fell out of bed, it was 40,000. So, but that's only 15% of the weighting. If you look at the actual share, the Asia Pacific, it had the name Asia Pacific because when we started in 2008, it was targeting Taiwan and Korea and Hong Kong. Now, as you know, Viv, these shares have a 5-year life. After 5 years, the investors have the right to sell their shares or keep their shares. If you keep your shares, i.e. you roll the shares into the next 5 years, you haven't sold, so there's no capital gains tax. Okay, that's very important. But commercially, you lock in all your profits because whatever profits you made in that phase are now part of the new capital guarantee. So you deleverage all your equity risk. Now, why that's important, if you don't do that, you could invest for 30 years and it could be up and down for 30 years. And then in 1 year, at the end of the 30 years, everything falls 50. Then you lose half the money that took you 30 years to build. You lose in 1 year, which we don't think is very clever. So have a look here. This share started, this was the Aussie dollar share class. I was an investor from the beginning, which I still am. I put in 1,000 Aussie dollars. After 5 years through the crash, it went to 1,080. So it only went up 8% in that time. Then it went to 1,7. That's where we started the current phase. And every time you roll, you lock in a new floor. Can you see the floor where my cursor is? And a new upside. Now we're going to put a new floor and a new upside. But because I haven't sold the shares, I've got no tax liability. But my capital guarantee now moves to wherever I lock in the current number. I just did a comparison here, Viv. If you had put the same money into the JSE when we created Asia Pacific, after 5 years, the Asia Pacific was up 50 and the JSE top 40 was up 43 in Rand, normal performance. Another 5 years later, the Asia Pacific was up 150 versus the top 40 at 105. And now 5 years later, the Asia Pacific's up 357 versus 147. So I, as an investor in this share, have made 200% more profit. I never had any capital at risk because every phase I had a capital protection, and I haven't paid any tax because I haven't earned any dividends or sold any of my shares. And effectively, I can now kick the tin down the street again by just locking all the performance in that I've got so far and then having another go. So what does that mean? It means that if in future it crashes, I'll come back to where I last locked in. Okay. And if in future it goes well, I get that 160% gearing on my money and the money I didn't pay away to tax, on the gross money. Do you see it? That's the reason why it's very difficult to beat such a thing, because a normal investor, if they buy shares or unit trusts or ETFs, they can't make the money without paying the tax. Because go and sell your share portfolio, you immediately have to pay tax. Then you have to come back to the table to invest after tax. This investor grows at a gross return, and because you've got this 160% gearing but no downside, it's got a very high reward for the risk you're taking, because you've got the best asset class with gearing with no downside. So it's very attractive. If we look at the expected Rand dollar, this is a few days old because the Rand's strengthened a bit, but the curve is the curve. This is if you wanted to take out forward exchange. It's showing that the Rand to devalue about 22% over the next 5 years. Now, whether that will happen or not, no one knows. Some people think the Rand's a bit weak as we speak, but you know, we can't say. All that we know is that one day when you sell these shares, just to highlight, you only pay tax on the profit in a foreign currency. So if I, who have bought it at 1,000, was to sell now at 2,600, I'd pay tax on 167%. But if I'd bought the first day, like Richmond or SA Breweries or a feeder fund, I would pay tax on 357. You see that? That's the rand equivalent profits. So I save a lot of tax by paying tax on the profit in a foreign currency, especially if I'm living in South Africa and the expectation is that the rand will weaken over time, you know, just with purchasing power parity and the like against the foreign currency. So those returns of 10.4 per annum is in dollars. What I can get in a bank account, if I just leave my money now in a bank account in dollars, is what, Viv? 2.5, 3? I don't know. Taxable. Okay. So this is the advantage. And then the fees, the costs and expenses. If you're a client already and you're rolling your shares, there's obviously no new costs. But built into the pricing was that 7% I was speaking of, which is a 0.5% cost provision for the lawyers, the auditors, the tax exemption. It will come out lower than that because the volume is so big, but that's built in. And then there's a 0.5% per annum for you, Viv, the distributor, plus a 0.5% per annum to Investec as the investment advisor to the company. And then the administrators is 0.13 in the first year and 0.11 thereafter. But all these fees and costs are built in. There is a discretionary fee, and I don't know to what extent you guys charge.
Never do.
Okay, you don't charge.
Okay.
So that makes it a very good deal for the client. Because if you just think of it commercially, Viv, if the client had to take out insurance by just phoning a bank and say, protect me for 5 years, it would cost 15%. Here you're giving the client a share that's fully protected. You're not charging him for the protection because the protection is part of the design. Okay. Second, if I said to you, say you were the shareholder or the investor, and I said to you, you must please identify for me which fund manager is going to give you 160% of the index performance. It would be down to 3% of fund managers, maybe 5. But which 5? Can you give me their names? We don't know, hey? We're only going to know in 5 years' time. Okay. But if we're wrong and it all goes down and ends in tears, there's not one of them that I know that will put his money in his pocket and get the change and give it to you so that you can go to sleep without losing. Okay, that's not going to happen. Then lastly, what we did, Viv, is we actually bought the bonds already in the market, and we've been very fortunate that the yields have come down, the credit spreads have come down since we bought. So we've actually got a nice portfolio of bonds at a very good price. We just did this table when we launched because we didn't know where interest rates were going to go up or down. And we were just showing that if interest rates went up during the launch, there would be a potential market loss for the client where they open a share in the company. But if they held it to maturity, it wouldn't have impacted them. But that's not coming to play now because we're now in the opposite, where rates have come down. So we're going to have a profit, which is obviously a nice position. We do anticipate, though, getting more applicants than what we've already got stock on the hedge. So we'll buy those at the current prices, but we're quite confident that we're going to give at least 150 gearing and most probably 160 or even more on the upside. But I'm just going to quickly see if I'll stop the recording there or stop sharing. I just want to see if there's any questions that anybody has. At this stage, I'm not seeing any questions yet, Viv.
No, you can ask the questions into the Q&A box or via chat, and we'll answer them as we go along. Feel free. I mean, I'm sure if you have a question, other people have the same question, so there's no silly questions.
Yeah.
Just one thing I want to point out about this particular structure and this particular thing Investec is doing. So when the market falls, let's just say the market falls from 100 down to 50. To get from 50 back to 100 is 100% return. Okay. The minimum investment amount, Haroon, is $11,000, which is quite cheap. I mean, the previous one we did was $18,000, $19,000, wasn't it?
Yeah. What's happened? These shares have done so well that we've got to bring it down to 5 shares now. That's why it's only $11,000. Yeah. It's because the markets, the shares have gone up and the rand's weakened. Yeah. 11,000 is the minimum.
Yeah. And so at the moment, that's just under 200,000 rands, I believe. So that is the minimum. In terms of offshore transfers, we will do the offshore transfer for you. We have the facilities. to actually take that money out of the country. Or if you had money overseas already, you can invest it directly. Okay. Any other questions?
So maybe Viv, just on before we get to your questions,
Hmm.
I'm going to see there's a question coming through, but just on the process. So what happens here is that the investor can put in their 1 million allowance or their 10 million tax cleared allowance, or they can use money they already have overseas,
Yeah.
or they can use I don't know whose asset swaps you use if they've got rands only. Do you
Yeah.
have access to asset swap?
That we've done with you guys before, and with other facilities as well.
Okay.
So
Yeah, sorry, Viv. So I think that any particulars about how to invest, how much to invest, all that Viv and the team will handle. What I'll look at now is just to see. Let's see. There's another question.
yeah, it's $11,000, by the way. That's about 200, just under 200,000 rands. Just factor that in, considering where the market is at the moment.
Yeah, so the client needs at least 11,000, not rand, dollars.
Yes, that's 200,000. It's about 190,000 at the moment, but just putting 200,000 as your minimum.
Okay, and I'm just seeing the next question. Is the capital protected irrespective? Yes, it's irrespective of the fall. There's no barrier. There's no downside. You know, it's 100% capital protected. And then Colin's question is, can a person invest via crypto? Not that I know of. Maybe Viv, you guys have a way, but we don't as Investec.
We sell the crypto, get the dollars, and then we can invest.
But you'd have to invest quickly in case the crypto goes down, I think.
Yeah, that's true. Yeah, no.
But yeah, so no, not that I know of on crypto.
Just understand where this comes into your thing, right? In your as Japie was saying, you need to have different kinds of baskets for your investments. Some, like I always say, there's bread and butter money and there's caviar money. Your bread and butter money is the money that you make sure, no matter what happens, is protected. This falls under the bread and butter section.
Yes.
The caviar money is the crypto. Oh, I want a caviar one day. I want a yacht one day. I want that private plane. That's not where this comes in. This is for giving you a very good return and protecting your money. Okay. The other part, that more aggressive kind of stuff, we could talk about it on a separate thing, but this is about more protection. Arun is asking, when is the offer closing? So it's basically the end of this month, the first week of December.
Yes, it closes to December.
Yeah.
It closes to December.
Oh, it has done significantly better than retail bonds, but just because retail bonds up to this point have been quite cheap because of the fact the market's been,
well, let's take that, Viv. I think let's take that question. We've got the info here because remember we said that from cumulatively from 2008 to now, 2008 to now, it's done 357. So I don't know if you've got a calculator, you can check from 2000 to get to 357 yield. How much would that have been? And SA retail bonds on average for that term might have given us what, 8? So just do the math. I've got a colleague who's very good at maths. I'll ask her. Just give me 1 sec. If we do that 357 return from 2008 to now, what's that IRR? So I've just got my colleague having a quick check for us because that's a good question. But very importantly, the SA retail bonds, typically would attract income tax. So it's fully taxable on the interest you receive. Whereas here inside the share, at worst you pay tax on the on capital gains when you sell the share. Okay, so in other words, there's a huge tax difference, but we're going to come to the return in a second. I've just got a colleague checking for us. Yeah, over the period from 2008 to 2008 to now.
That's 15 years, 12, 14 years. 14
years, yeah. We'll just check quickly how much that was.
Is it the rand return or dollar return?
That's the rand return, because that's on that. Remember, I shared that graph, what we compared the rands. Just go back there. I'll just show you. So when we were looking at this graph, you can see here, if I started in 2007, it was 6,700 per share, and it's now worth 30,797 per share. So it's gone up 357%. So we'll check now how much that 14-year IRR was, which is so it comes out at 9.3, Viv. So 9.3. So if you think back from 2008 to now, SA government bonds, probably the yields weren't as high as they are now. So I'm thinking maybe the average was 8. But the
Yeah,
point is that it would have been 8 fully taxable as income tax.
yeah.
Okay. Versus 9.3, which hasn't attracted tax for me yet because I haven't sold the shares.
But it does
Okay.
with capital gains.
And if I sold, I only pay capital gains. Yeah.
Yeah, and won't be
That is
capital
a good
gains on the
question.
whole 300%. It'll be capital gains on the foreign currency amount, which is 200 something percent.
Yeah,
Yes.
exactly.
So
So this, I'm just going to check the questions, make sure that we cover all the questions.
Arun, I think it's Arun's got one below that. If you mind moving it up.
Just go that one, yeah. Missed the
Okay.
beginning, in which, yeah. So the markets then are 40% of the basket is S&P 500, 30% Euro stocks, 15 Nikkei, and 15 emerging markets. That is at index level. So that combination is 98%, the same thing as the MSCI World All Country.
Yeah. So
And then the question from Bruce, Bruce is saying, can this investment be held in an offshore company? Yes, absolutely. Any investor can buy. In other words, the shares have got an ISA number and a Bloomberg ticker, like Microsoft, like General Electric, like any other share. So it can be bought from anywhere. You just need to give the FICA of the investing entity.
yeah. And also, if you have a local company, we've done this in the past with Japie, even NGO, or we've done like with trust. So we just need to do an asset swap, and we can still do this for you guys. Just get in touch with us quite quick, and we can get the process going. And will there be a replay of the webinar? We plan on putting this up on YouTube. So we have a Rand Swiss YouTube channel, and this should be up by tomorrow on YouTube as well. Is there any more?
Any other questions?
Okay. Anyone else with questions? Okay. Just like Japie was mentioning, is the MSCI World Index that we are working on. Look, this is the whole world. So in terms of thinking of diversification, you're basically investing in the whole world. There is no particular, there's some markets like the S&P or Europe might be a bit bigger than some other markets, but basically what we're doing is representing the whole world's financial markets in this particular portfolio. You have access to emerging markets, to the biggest markets in the world, to East Asia with Japan, etc. And what that means is that, if there is some kind of, event, let us say a Taiwan-China war, or, some kind of, breakup of the European Union, we talk about the wildest of wild swan events. Some areas will profit, some areas will go down, but you'll be getting the profits as well as the losses, and the combined amount will be coming through. So you're basically protected against a catastrophic risk in any particular area. And the second thing is, can you explain to them how the levels at the end of the are taken down as well?
Yes. So maybe just to add on to what you've just said, Viv, one other very important thing about that is, if you're investing in indices, one of the advantages of that is that if you think of the 5 years ahead of us, we don't know which sectors of the economy are going to do better than which other sectors, because it's going to depend on inflation and viruses and wars and no wars, or 20,000 things. The index exposure helps the investor because you're only retaining the exposure to the shares that are doing the best, because the shares that are doing poorly are falling out of the index or getting a lower weighting in the index. So by having the whole world's exposure and having your exposure by virtue of the indexation enables you to have the asset class, the one that gives that 49,000 cumulative growth, because it's the best shares. Okay. Now, what we do at the end of the term to mitigate what we call PIN risk being the risk of a specific date, is that we take the average level of the market for the 4 months or 3 months preceding maturity. So, for instance, the existing shareholders, the indices in the current one are up about 15 or 17%, because that one had a 240 gearing. We're looking to make about 35, 40%, but we've already locked in the index levels in September, and October. Now we're going to lock in another one in November, then the last one in December, to reduce the risk that it looks as if you made good money for a long time, and then all of a sudden, the week before it matures, all of a sudden it falls out of bed, and then you get a much lesser return.
Yeah. Look, I mean, it hardly ever happens, but when it does happen, you don't want to be in a situation where this affects you. Okay, so after
I just
5 years,
see another question. So after 5 years, the option will be to continue the investment. Does one then invest for another 5 years? Okay, yeah. So at the end of 5 years, we go to the shareholders, Roon, and we ask them, do you want to stay invested or do you want to sell? That's, for instance, what we're doing now with the existing investors. Should you keep your shares, then by deduction, you didn't sell them, so you got no tax, but you lock in all the profits you made. And if it was a bad period, you get your $100 back, and you can go buy the market the next morning available at 70 or 60, wherever the market fell to. You can't invest for a yearly basis. You either then say, I'm going to stay again for 5 years, or I'm out. Bearing in mind, during any 5-year period, you've got daily liquidity. So in other words, you can always sell during the 5 year, but it is best to see it as a 5-year investment.
okay, there's one more thing I want to add on that, right? The way I tell clients to behave with this thing is to hold this almost to retirement. Just reinvest it all the time. Why? Because what you do is you basically get your money reinvested every 5 years. And, Japie did say he didn't do it this time, but he does it occasionally. He readjusts what's the underlying, indices that he has in his portfolios. So he basically makes choices about, like rebalancing the portfolio, let me say, right? Let's just say you start off as a 40-year-old, okay? You do this until you're 65 and you retire at 65. So you've done it 5 times in a row, okay? What that means is for 25 years, you've had this investment that's basically been rebalanced every 5 years, that has locked in profits every 5 years. And at the end of, say, 50, 65, and you want to retire, then in that year you retire, you don't have any income if you want to do it. You can basically, coordinate how much income you have in that year. And then when you take out the profits of this particular portfolio, you'll be taking out all those capital gains at a point at which you have no income or very low income. And so you'll actually pay a far, far lower capital gain, tax than you would have had you been forced to basically pay capital gains every 5 years as you rebalance your portfolio. The rolling yeah.
No, that's true. Sorry, and the other important thing about it is that you're now getting the growth for that 25 years on your money plus the tax you didn't pay.
Yeah, exactly.
Yeah. And then I see Akbar asked a question relative to the MSCI. You see that we underweight USA and overweight Euro. That is 100% correct. If you look at that valuation we showed there, the Euro Stoxx 50 at the moment is exceptionally cheap by long-term standards. So our view is the Euro as a currency is very, very weak, and the US dollar is very strong. So you would imagine over time that the companies in Europe with the euro being so weak, would make more corporate profits, and their shares would be available on the market cheaper. Viv, much like you had with the rand in history, when the rand weakened, it was good for the JSE. The similar principle would be for the euro area. So what we have in our portfolio is we want to be able to say that it's 98% correlated to the MSCI World. But the weighting, we prefer to have less US simply because it's the more expensive in the combination of indices than the others. So the 60% or much cheaper relative to the long-term average PE ratios than what the what the S&P 500 is. So it's intentional, but we could be totally wrong, and that's why we want 100% capital protection. But because you're getting 160 gearing, Viv, on the whole portfolio, it's unlikely that the direct MSCI would beat it anyway.
Yeah. I can just explain the euro currency and the payout is in dollars, right? Or
yes,
dollars.
US dollars. These are all US dollars. It was just in the first phase was Aussie dollars. That was just showing you the Aussie dollar share class. But the assets now is all US. So what happens, if you're going to get, or the investor is going to get 30% of the exposure, which is to the Euro Stoxx 50, they're just going to take the Euro Stoxx 50 index performance, like you see it on the screen on Bloomberg. It went from 3,000 to 4,000, or it went from number A to B. That's a percentage. It's that percentage is already in dollars in our case,
Mm.
because we get the bank to quanto the options into dollars. So in other words, our investor gets all the returns in US dollars,
So
as
like,
opposed to someone who buys the euro in euro. He's getting his returns in euro, which is a weak currency.
so like imagine like you bought the JSE, right? The JSE goes up 5%, but instead of getting your payout in rands, you get a 5% dollar payout on the JSE.
That's it. That's the way to look at it.
So, and in fact, what that means is that because the euro has these issues in it, and the yen has these issues in it, it actually benefits you. If the yen basically was to go to 300 or 500 to the dollar, crazy numbers. Remember, the yen has the Japanese have the biggest budget issue in the world, the biggest debt issue in the world, right? If their currency blows out, because they have all these companies like Sony and Mitsubishi and Toyota that make basically their money overseas, it just means the currency gets basically translated to a much higher stock price.
That's
and
it.
therefore those stock prices basically translate automatically to dollars. So you get the benefit of the weaker currency and none of the penalties.
Yeah.
It's like if the rand goes from say 18 to 50 right now, the JSE will go ballistic and you get this huge JSE movement, but we'll get paid out the movement in dollars as opposed to sacrificing it in rands.
Yeah, so that's exactly how it works. Now, Bruce's question is, what's the penalty? So, Bruce, you get a 1.25% early redemption fee. So if you sell early during the 5 years, if there's a natural buyer, then there's no fees, willing buyer, willing seller. But mostly we find that we as Investec buy the shares from the client. And Viv, then there's a 1.25% early redemption fee, much like if you sell your Sasol or your Anglo-American or Capitec, you have a brokerage fee. Whereas this is the fee, then we take it into stock and then we on-sell it in the market as secondary stock.
Yeah, and
okay, so in which currency? So it's just a question, in which currency? Sorry, Viv, you wanted to say?
Oh, yeah, I just want to say something. I've done this a number of times in the past. Sometimes people have passed away. Sometimes they have cash issues. Investec is always going to be there to buy your stuff. They're very good. They are ones that took a month to sell something because the client wasn't happy with the pricing as the market was getting volatile, and they'll send you a price every day basically to say this is the price. It's a very easy process to get out early if you want to, and they are actually on the other side to make sure that you do get out. Okay.
Yeah, and then Haroon's question is, in which currency is investment? This is all dollars. It's a pure US dollar investment. So it's not a basket of currencies. It's just US dollars. All the calculations, everything is in US dollars.
And
then Ray,
right?
Sorry, what?
Even to the Aussie dollar one, it's still going to be a US dollar eventually.
Yeah, that was just a legacy share class, but everything, the maths and the assets of the company are just US. Then Ray's got a good question. Does this vehicle make sense for younger investors, say someone who's 30 who might want to exit this product in say 15 to 20 years time when their personal income bracket is likely to be higher, i.e. do not get capital gains reduced rate when the income is low after retirement? So what happens there, Ray, is that the investor can sell as many shares as they wish. So let's say you, as an investor, wanted to sell some shares so that you can have the lower tax rate. There's nothing stopping you. You can sell the shares whenever you like, when your rate is low or high. But mathematically, it's still better as an investor to not pay tax and have the growth on the return for your money and the saved tax, even if that's for 15 to 20 years. Because compounded over a long period of time, you're then making a lot more money. Because if you want to pay the tax, you have to pay the tax every 5 years. And consequently, you're investing after tax. Whether the rate is a bit lower, you save a bit on the tax, but you still have to pay away tax. Does that make sense, Phil?
Yeah. And I mean, with regards to this particular product, I mean, you like Japie said, you can exit whenever you need to. So let's just say there's a year that you can basically do something with your taxes. That can be the year you exit. Your taxable income, let me say, right? So you can have a year where your taxable income might be low. Maybe you're taking some gardening leave. Maybe you've taken a year off or whatever. You can use that year as the year in which you basically exit this product, and then you pay taxes in that year to try and to get out. Okay.
Yeah, or else you decide, Viv, you decide, this year I haven't got any other capital gains. I haven't sold any other stocks or made capital gains. So I'll just sell some of these shares and realize some capital gain because I've got an annual exemption or concession anyway. So that's your freedom. You can do whatever you like.
Yeah.
So some people plan their tax much more tightly than others, but I still, in my view, it's still always very good to have an ability to defer the tax for another day.
Yeah. And what's, yeah.
I'm not quite with this question from Ray. Exit this product. You can exit, you can sell the shares whenever you like.
So he basically, the misspelling of the first thing, I think he just corrected it. Okay. Lendro says minimum investment's $11,000, so it's quite
Yes.
low, under 200,000 rands. And like we will do the transfer for you if you need it, or you can use overseas money or could do a transfer with somebody else. But we will help you that if it's required.
Yes. Let's just go to Haroon's question. So mention has made a gearing, and can you just explain where the gearing comes from? So what happens, Haroon, is that we get $100 from all the customers, okay? We're going to put 71% of that capital on day one in the bonds from Citibank, which grows to 72, 73 and matures at $100. That's the 71% that enables us to say to you, doesn't matter what happens to the stock exchange, you're going to get your $100 back unless Citibank defaults. Secondly, we're going to put aside 7% for fees, costs, and expenses for the 5 years and tax exemption, audit, all the costs, all the fees, all the expenses. And so on day one, we've got 22% cash in our hand. And what we do is we price a call option, which would give us unlimited upside on 100. That actually costs today 22. But we don't think the market's got unlimited upside. So we sell away the benefit if the index went up more than 40. And they give us a credit of 8.5. So 22 less the 8.5 is then 13.5. And if you've got 22 to spend and something costs 13.5, you can buy 1.6 of them. So that's where the gearing comes from. It's not from borrowing money like a hedge fund, Viv. They borrow money to get gearing. Here, you're just buying more exposure by having more cash than you need to buy the options. Does that make sense?
Yeah. Look, I mean, if you want to, we can go through it in detail. It's slightly more complicated than most people that are not in the industry would be able to understand. But basically, what he does is he divides the investment that you give to him in two parts. One part is for guaranteeing, and one part is for the return. And because the part for the return is a bit more than he needs to just give you that return, he's able to give you a greater number than basically 1 times the market. He'll give you like 1.6 times the market, just because of the clever stuff Japie does behind the scenes.
Yeah, and so what you do with that, Haroon, is you're saying, if I think the market's only going to do 40 because that's the 120-year average, then I'd rather get 64 when the market only did 40. So the way you do it is to sell away the benefit in case the market did more than 40. And by getting a credit from the bank, you use that money to give yourself a higher exposure for a return up to 40. But we can go, if anybody wants to phone me, we can go through in much more detail independently. Can I use this investment as part of my retirement savings? Yeah, absolutely. I mean, it's ideal for retirement savings because it's when you get your retirement that you need, to make sure you got dollars and capital. So if you're living in South Africa and I say to you in 20 years time or 30 years time, you know that you've got a certain amount of dollars saved without putting those dollars at risk, but still being able to get geared equity upside. That is absolutely ideal.
So I'm just going to make sure that they're asking as a retirement savings as a concept, yes, but I'm not sure it can go into a retirement annuity.
No, if it wants to go into a retirement annuity, what you have to do then, Viv, is you have to have like a share portfolio, and you're going to be able to buy it into a share portfolio in a retirement annuity. So that would depend on the administrators of that. Yeah. So that would you'd need to check out from an individual perspective, but using it for retirement would be ideal. So, but practically, you'd have to help them on how to do it.
As a pension, part of your pension, probably we have to talk about that. But as a retirement concept, yes.
Yeah. Then, coming to the question, can you partially exit or do you have to sell down full holdings? No, you can sell as many as you want and keep as many as you want. You don't have to sell all of them. You will have to retain at least 5 shares. So the 11,000 is commensurate with a 5-share purchase, Viv. So if you only bought 5, then you'd have to sell all 5. But if let's say you bought 20, you could sell, 15 and still retain 5, or sell all of them. Yeah. There's a certain minimum that you have to hold. So it's either naught or that minimum 5 shares.
Could you be part of a living annuity? It depends. There are places that you can get a living annuity done into a personal share portfolio, and we'd have to ask the administrator if that is allowed for them. In some cases, it might be. In some cases, it might not be. Depends on the person. But give me a call afterwards, and we'll talk about the options.
Yeah, absolutely. Depends on the what we call the administrator of that. Okay, so let me just see what's the next one.
What's the ticker code?
Just can you? Yeah, sorry, we talked about the living annuity. Just give me a second here. I'm just going to get to the next question. Yeah, you can put in living annuity pension. What is the ticker code? In the presentation, the ticker codes in the presentation. Let me just say. Just give me a second. I'll call it up for you. I'll just share it. Just go back to it. So Bruce, it's in the Viv, you're going to attach the presentation, I suspect, eh?
Yeah.
There's the ticker code. So the ISIN, what we call the ISIN number, is in the presentation, and there's obviously a Bloomberg ticker as well. So Viv, for the client who buys the shares, they can just put that Bloomberg ticker on their cell phone. And if they go into the cell phone, they can get real-time pricing anywhere in the world or via the internet, wherever you've got the internet. And if you go into the ISIN number, or if you go into the Bermuda market, obviously you can call up that share. Okay, so let's go back to I'll just stop recording. I'll just go back to the questions, see if there's any other questions.
Anyone else with a question?
So it's very nice that the questions come through. It's a very efficient way of addressing them.
Okay, I don't think anyone else at the moment. Okay, so it's been an hour, but I think that's probably it. Okay, thank you, Japie. Always, very good to talk to someone like this. Japie is, is probably the premier expert on structured products in South Africa. He's been doing it for quite some time. He has a massive book, and we are quite lucky to have him come over and chat to us. We've done a number of these structures with him so far. None of them have failed. None of them have basically returned just capital. Okay, it's been a good market, but even in the current situation where this one is closing in a very bad market, we've had positive returns. We've had one structure close in the middle of June, July, the East Asian Growth Basket, right, which also gave us the maximum return, even though the market at the time, you remember, was a little tumultuous, let me say the least. The great thing about these structures, the guarantee is wonderful. 100% dollar guarantee in this current environment is something that you're not going to get in very many places. And I understand, like, over the last year or so, it's been become very clear that there's only one hard currency in the world. That's the dollar. The euro is not a hard currency. The pound isn't a hard currency. Hard currencies don't go up 20 and 30% and down 20, 30% in the period of like 3 or 4 months. Okay. And that's what we've been seeing happening with regards to the euro and the pound and so on. The dollar is the strongest currency in the world, the strongest economy in the world. It's the most secure country in the world. It's the linchpin of what's happening out there. And I think that every single person should have a core of their investments into something that has a dollar guarantee. That means it's in US dollars, and there's a guarantee that you won't lose those dollars should there be a bit of turmoil in the market.
Yeah.
Okay.
I think Viv, maybe just for the watchers of the clip, to give you some idea of our track record. So since I've started this business 22 years ago at Investec, we've got a team of 11 people, and we've now launched 181 worldwide listings. Of the 181 that we've launched over a 20-year period, this one that we're talking about today is the 101st one to mature, come to the end of its term. Of that 101 that have matured, we've returned capital only. In other words, what the capital the client gave us 8 times. And one of them was that one that we showed in the presentation. The other 93 that matured all made a profit. And touch wood, we have been very lucky over a 20-year period that not one investment that we've put out there has actually resulted in any client ever losing a cent in 20 years. And what that's enabled us to do is build a business from a few ideas I had. We now manage 25 billion rand of assets. and we've got 15,500 live transactions on our books. We've also just recently, a few weeks ago, been given for the 5th year in a row. It's only existed for 5 years, the worldwide accolade from Euromoney as the best bank in the world that does structured products and derivatives into Africa amongst all the banks of the world.
Yeah. I mean, I wasn't kidding when I said this guy is the best in the country, in the world as well. Yeah. So will this be available for rewatch? Yes, we are planning on putting this up on YouTube. It should be up by tomorrow. So this will be all on YouTube. We will also send you basically the presentation, the PowerPoint that Japie just showed you guys. And yeah, sorry, how do you get in touch? You have our contact details. You can email viv@randswiss.com, or you can basically Google Rand Swiss and there's the contact details there and get in touch with us. We have 2 weeks basically before this thing closes. So if preferably get in touch with us like this week or so. Also, coincidentally, the Rand is much stronger than it's been in the last, month or so. This week, it's 17.20, 17.30 last time I checked. For much of the last, a month or so, it's been above 18, and often, one day 18.50. So we're talking about a 6+, 7+% move from the average, and a 10% move from the worst it's been. So if you want to get in, this thing, get in touch with us as quickly as possible so we can actually utilize this stronger currency to get your money out as quickly as possible.
Yeah.
Okay.
I think one last point from my side, Viv, is that although the Rand is a bit on the weak side, one has also had the equities are 20 down. So the entry level on the equities, is also down. So they sort of compensate each other. But you can't say for sure, what will happen. We don't know.
Okay.
But thanks very much.
Okay, thanks, Japie, for coming through, and thank you guys for joining us as well. We will be putting up the link, and we'll be emailing everyone that joined here today the link on YouTube, and we'll also be sending the presentation to you guys as well. Look forward to getting in touch and moving forward on this thing. Okay, thanks.
Thank you.
Yeah, thank you, Japie.
Cheers, then. Bye.
Cheers.